President Joe Biden said a recession in the U.S. is possible, but that any downturn would be very slight and that the U.S. economy is resilient enough to ride out the turbulence. Yet Americans are struggling as prices continue to soar, the cost of borrowing is ever increasing, and the layoffs are on a rise across the country. Fear of economic shutdown lingers, but still the reality is yet to hit President Joe Biden. On Tuesday, the International Monetary Fund slashed its United States growth forecast for 2022 to 1.6% and that of 2023 to 1%, warning of a worse outlook for the global economy. We will be focusing on the sad tale of the declining economy of America and how Biden seems to be in the dark as to the effect of his bad policy in fulfilling the American dream. Please watch, like, and share this video. Drop your comments and observations below and subscribe to the channel for more videos like this. Let's dive right in. Bloomberg Economics Recession Probability model in September pointed to a 30% chance of a downturn starting inside the next 12 months. That model-based estimate may even understate the risk, with accelerated Fed tightening making a recession a high probability in the second half of 2023, according to the Bloomberg Economics US team. Still, Biden has repeatedly said he doesn't expect a recession and has often disagreed with analysts or Republicans who have speculated that a downturn is a must if the current situation is a possibility. The state of the economy is a potential liability for Democrats heading into the November midterm elections, in which Biden and his party are campaigning to hold on to slim majorities in both chambers of Congress. Warnings abound that the U.S. economy is poised for a slowdown or contraction. J.P. Morgan Chase and Company Chief Executive Officer Jamie Dimon said this week that headwinds are likely to put the U.S. in some kind of recession 6 to 9 months from now. Chair Jerome Powell has warned that there may be economic pain coming from the central bank's steep rate hikes. The Fed is poised to deliver its fourth straight 75 basis point hike when it meets early next month. At this point, the larger risks come from tightening too little and allowing very high inflation to persist and become embedded in the economy, Federal Reserve Bank of Cleveland President Loretta Mester said Tuesday during an event with the Economic Club of New York. Truth is, price pressures are not going away, and the oil and gas prices are following the same as they are heading higher once again. This is definitely as a result of the Organization of Petroleum Exporting Countries and its allies, a grouping known as OPEC+, who last week decided to cut oil output by 2 million barrels of crude per day. This move has not just increased the cost of energy but also for everything buyable, meaning the price of everything will go up, including food. Recently, U.S. GDP, a yardstick of goods and services output, reduced with a 0.6% last quarter after contracting a 1.6% between January and March. And one of the common rules of thumb for detecting a recession is 2 successive quarterly declines in GDP. But the Biden administration continues to argue that the economy is resilient, relating to the lowest unemployment rate in 5 decades and unshaking consumer confidence. According to a Bankrate poll, about 7 out of 10 Americans stated their worries about a recession, while the others said they are financially unprepared to handle a recession if it hits before the end of 2023. More than 8 out of 10 CEOs recently said they anticipate a recession during the next 12 months, according to a new survey from accounting firm KPMG. Out of the 1,300 CEOs at the world's largest companies KPMG surveyed, 73% said they believe that an economic downturn will disrupt growth. About 39% of the CEOs have implemented a hiring freeze, while 46% are considering downsizing their employee base during the next 6 months, KPMG found. It is difficult for us to ignore this data, but Biden seems to be doing a great job at it. So what are the key metrics pointing to? How do economists make sense between plummeting markets and a resilient labor market? And what does a U.S. recession mean for the global economy? Wall Street has plummeted in the past year. The S&P 500, a proxy for the health of retirement and college savings accounts, closed the third quarter at its lowest level in almost 2 years. Cryptocurrencies, which surged in popularity and price during the pandemic, have also nosedived, with the world's top digital coin, Bitcoin, slashing over 60% of its value in the past year, while the second largest coin, Ethereum, has dropped more than 61%. U.S. mortgage rates have also doubled, taking billions of Americans out of home ownership. The U.S. would have been experiencing a mild recession if the President, Congress, and Feds had acted sooner, but now there is lots of economic pain at stake. One of the flaws of Biden's administration is its hindsight. The best way would have been for him to look back at their immediate predecessor and learn from the techniques that worked and what didn't. Instead, they continued with bad policy. A policy that has rendered tens of millions of Americans jobless. Since then, businesses from gas stations to doctors' offices have struggled to find workers. The fact is, as long as job openings remain high, the Fed will continue to raise interest rates to make borrowing more pricey in hopes of balancing demand and supply. New data showed last week that the number of job openings in the U.S. plunged by 1.1 million and jobless claims increased more than expected. The unemployment rate hit a half-century low of 3.5% in September, however, signaling a tight labor market. I don't see a strong labor market, I see a desperate labor market, Heritage Foundation's Anthony told Al Jazeera. We have a disproportionate number of people working multiple jobs. That goes against the jobs numbers because every time a person works another job, they are counted as another job holder. We've had a lot of small businesses fail from pandemic lockdowns, and if those people go to work for a large corporation, they are now counted in those surveys. So again, even though the number of jobs hasn't actually changed, the number of people employed, the number in the survey, goes up, Anthony said. Talking about global recession, the pandemic and war in Ukraine have led to extraordinary shocks to the global economy. The World Bank recently stated that measures to cut off extreme poverty by 2030 have been cut short. World Bank records revealed that people living on just $2.15 a day increased 11% in 2020, from 648 million to 719 million. A U.S. recession would cause deep pain in the developing world, Richard Kozelwright, director of the Globalization Division at the United Nations Conference on Trade and Development, UNCTAD, told Al Jazeera. A recession in the U.S. would mean that the dollar's days are over. And some relief would be good news for emerging markets. But again, if the U.S. dips into a long period of sluggish growth, emerging markets are going to struggle. Major exporters to the U.S. such as China, Mexico, and Canada would feel pain if U.S. demand weakened for a prolonged period of time. The BEA recently reported the Personal Consumption Expenditures, PCE, price index rose 6.3% year-over-year in July. Core PCE, the Fed's preferred measure of U.S. inflation, was up 4.6% from a year ago. While core PCE growth is down slightly from peak levels of 5.3% in February, it remains near multi-decade highs last seen in the 1980s. Consumers are feeling the brunt of increased costs for everyday goods and services. The Bureau of Labor Statistics reported on September 13 that the Consumer Price Index, CPI, a measure of the cost of living, soared by 8.3% from last year, even as gas prices started to decline. In response to alarming inflation, the Fed has raised the federal funds rate substantially this year, including 75 BPS rate hikes at meetings in June, July, and September. With inflation remaining stubbornly high, the Fed had to implement yet another hawkish pivot by raising rates another 75 basis points and signaling to markets that additional increases in rates are appropriate to bring down inflation, said Charlie Ripley, senior investment strategist at Allianz Investment Management. At the time of this video, the bond market is currently pricing in a 65% chance of a 50 BPS rate hike and a 34% chance of a 75 BPS rate hike in November, according to CME Group's FedWatch tool. There's a 1% chance shot at a full percentage point increase. The higher interest rates rise, the more expensive it becomes for U.S. companies to borrow money to invest in innovation and growth. Rising credit card, mortgage, auto loan, and other interest rates also reduce the disposable income Americans have to spend in the economy, weighing on corporate earnings and stock prices. Of course, that's the point. The Fed wants to quash inflation by slowing down the economy. They hope they're able to do so without causing too much damage, which is impossible. Concerns about a U.S. recession ramped up in early July when the yield on 2-year U.S. Treasury notes jumped above the yields on 10-year Treasury notes, a phenomenon known as a yield curve inversion. Inverted yield curves have historically been another strong economic recession indicator. 2/3 of the time, the U.S. economy has historically fallen into a recession within 18 months of a yield curve inversion. The current yield curve inversion is the deepest since 2007, the year before the notorious global financial crisis. If the U.S. does slip into a recession sometime this year or in 2023, there's no reason for investors to panic. But with the current administration, the reverse is the case. Even though history reveals that U.S. recessions don't last very long, U.S. recessions are also fairly common. Since World War II, there have been about one U.S. recession roughly every 5 years. While recessions can lead to job losses and other financial difficulties, it also makes it difficult for investors to time a market bottom perfectly. Biden is sure to neglect the clear signs of Americans' economic fallout, and this will be detrimental for not just Americans, but the world at large. Please drop your thoughts and observations below. To support us, please watch, like, and share our videos. You can also subscribe to the channel and turn on post notifications for more videos like this. Thanks for watching.